What is real estate depreciation and how does it work?
The basics of depreciation is a pseudo expense that the IRS code allows real estate investors to take as a deduction against their income on their properties.
What is the benefit of running such a high depreciation on year one? Like, how can that help individuals?
The power of depreciation is that it can reduce tax liabilities today.
Can someone qualify as a real estate professional without being a real estate agent, just as a real estate
Yes,
investor?
absolutely. Yeah, absolutely.
Yeah, they
There's
can.
plenty of trades. You're a developer. You're a redeveloper. You don't have to be an agent. By the way, being a real estate professional does not require licensing.
Hi, everybody. Jose Luis Morales here. Welcome back. Today we've got Big Mike on the show. He's coming to us from Brooklyn, New York. Today, Big Mike is going to be explaining to us depreciation and how it can help you as a real estate investor to pay less in taxes. Welcome to the show, Big Mike. How are you?
Hi, Jose Luis. Thank you very much for inviting me. I'm doing great.
I wanted just to start off by asking who is Big Mike and how did you get involved in this wonderful field called real estate?
Well, I'll give you a really short version. I grew up actually in the republic of what used to be Soviet Union called Moldova, former. Now with the war in Ukraine, people actually know where's Moldova on the map. Moldova is next to Ukraine on the western part between Romania and Ukraine. I immigrated as a political refugee from the Soviet Union to the United States. I ran away from communists in 1989 with my mother. So we are U.S. citizens, U.S. patriots. Obviously, we condemn the war, and it's crazy what's going on over there. And we have family in Ukraine, so it's very sad and terrible what's happening. But I'm U.S. educated, a mathematician by education. I spent almost 15 years in technology, had a very successful career. But I realized that my passion was always real estate. I started investing in real estate in 2000. And then 2009, I went real estate full time as an investor as well as a fund manager. So it's been a journey. It's been fun. It's my passion, and I live in Brooklyn, New York, with my lovely wife, four monkeys, and a cat. Monkeys being the kids.
So I wanted to jump on at some people who may not know what is real estate depreciation and how does it work?
Sure, I'll start with a disclaimer. I'm not a CPA. I don't play one on TV, and I'm a fund manager. We run a family of funds, and certainly our funds take advantage of the depreciation. But the basics of depreciation, it's a pseudo expense that the IRS code allows real estate investors to take as a deduction against their income on their properties. So every property gets a depreciation automatically. There are residential properties and there are commercial properties. So if you own a residential property, at minimum it gets depreciated over 27 and a half years, and commercial properties get depreciated over 39 years. That's a normal depreciation. That's the depreciation that the IRS allows most folks to take. And that's really boring, not really exciting. Nothing particular happens there. But real estate is one of the best asset classes out there. It's one of the most tax advantage. And one of the hugest benefits of real estate is the fact that there's a concept of bonus depreciation. So what is bonus depreciation? Well, bonus depreciation is in the code that incentivizes investment in real estate that allows investors, typically developers or operators, to depreciate the assets a lot faster than that 27 and a half or 39 years. And the way it works is typically there is a cost segregation study that gets run on a property. So let's use an example, a multifamily project. So cost segregation typically requires an engineer to go to the property and do a detailed breakdown between various components of the property. So typically the walls, the foundation, really the bones of the properties, they still stay on a 39-year depreciation. You can't do much about it. But there are also parts that get depreciated over 15 years. Some get over 7, some get over 5. The easiest example to see, you got appliances, right? They don't have 39-year lifespan. They get depreciated over 5 or 7 years. So these faster depreciable items, and you can include windows and doorknobs and doors and carpets and a lot of other things that can be depreciated faster. So these things go through the engineering report, and the cost sec study, that's the report, typically talks about what can be depreciated on what schedule. Then the bonus depreciation, it's been around for a long time. In the past, it was sort of renewed at 50% level, meaning that you could actually depreciate 5, 7, and 15-year schedule over basically in the first year, you can take 50% of that in one transaction. In 2017, the CARES Act under Donald Trump as president received essentially 100% bonus depreciation. What Trump did, what is good for Trump and what's good for real estate investors, because Trump is a big real estate investor. We all know that, right? Yeah. Some people love Trump, some people hate Trump. Without taking political sides, he was good for real estate investors. He was. This is the truth. And 2017 law essentially says you can now take 100% of that bonus depreciation in a single year in the first year. So you buy the property this year, you run a cost segregation study, and your 5, 7, and 15-year depreciation, this pseudo expense, this basically deduction that IRS allows you, so instead of running it over 5 years, you immediately take it in the current year. So the net impact of that is that on a project with a cost sec, typically multifamily is a classic example, investors could get very substantial depreciation. So just for sake of example, what does it mean? It means you can buy a property. Let's just use very simple numbers. I'm going to use small numbers for. Well, it's not small, not just not necessarily big, not necessarily tiny, but just $10 million property. So you buy a property for $10 million, small apartment complex, and you get a mortgage for $7.5 million, and you put $2.5 million down, and you have another $500,000 of closing costs, reserves, and so on. So you're all in for $3 million. You run a depending obviously on the property, the variance. Some properties are different from others, but you can run a cost segregation study, and in the first year through bonus depreciation can get roughly $3 million in bonus depreciation. So that's a very powerful technique. So you basically can write $3 million in the deal and get $3 million in depreciation. What does it do? Well, it creates passive losses, and it becomes, unless you're a real estate professional. So a lot of your audience sounds like the real estate professionals, the agents, the brokers. For real estate professionals, this gets incredibly more powerful because they can use what is normally passive losses coming from the depreciation as effectively active losses, because if they're a real estate professional and they do meet that requirement, and at the same time they also spend, this is a technical requirement, a lot of people don't understand this and they don't know this, but I studied the subject. Without being CPA, I know the rules. Again, I don't give advice, but the way I understand it, 500 hours of the 750 required to be a real estate professional must be spent on rental activities. You can spend more, but you can't spend less. So 500 hours on rental activities. You have to own a rental property, go pick up the trash, negotiate leases, do a bunch of other things, and actually materially participate. Materially participate means you have to go do the things with the property, not necessarily go look for other properties. So material participation has a bunch of technical definitions, but usually common sense. You repair the property, you upkeep the property, you negotiate leases. So long story short, if you do that and you're a real estate professional, you can take the depreciation as an active loss if you meet all those requirements, and you can do grouping election, and then it can offset other income that you have from being a broker or an agent or wholesaler or fix and flipper.
How does that work? Is it based on the purchase price, or is it based on purchase price minus land or just the building? How does that part work?
Right. You depreciate the building. You can't depreciate land. So normally you allocate a certain amount of purchase price to the land, a certain amount to the building. So in this example, if it's a $10 million purchase, maybe you can't depreciate the entire $10 million. You'll only depreciate 9 because $1 million will be allocated to the land. But normally just depreciate over 39 years. So whatever the purchase price over 39 years, and that's a deduction per year. But if you do bonus depreciation, that number goes up substantially higher.
And then the benefit, what is the benefit of running such a high depreciation on year one? Like, how can that help individuals?
Well, what's going on out there today? Inflation. The dollar is devaluing at a rapid pace, right? Don't you want to save on taxes today and then deal with it with the pay the taxes with the future dollars that are worth a whole lot more? Sorry, that are worth a whole lot less, right? So most people love the opportunity to get the deductions today, defer the tax liability until a future date, and get the deduction today. That's the driver. It's a massive driver, especially if you make a lot of money and you're in a high tax bracket. You're in California, I'm in New York. You also have local taxes that you have to deal with. But the power of depreciation is that it can reduce tax liabilities today. And if you're in a high tax bracket, it makes a lot of difference. And the other really interesting thing that happens when years down the road, when you sell the property and you have to pay taxes, under most circumstances, you'll be paying essentially capital gains tax rate, which is generally lower than your current income tax rate. So in the worst case, typically, again, consult with your CPA. Typically, you can trade off, get the depreciation today against your current income if you're a real estate professional, and have the grouping election, and at the same time pay the taxes in the future at a capital gains rate. A lot of real estate professionals, well, they get hooked on depreciation. I like to crack this joke. Once you get used to this, you sell your soul to the depreciation devil. What it really means is that you will probably not want to pay taxes for a long, long time. So when property sells, you'll find a way to roll the money into the next project with extra depreciation and kick the can down the road for a long time, as long as you can possibly imagine. And that's why people do, by the way, 1031 exchanges. They do 1031 exchange essentially to defer the gains. There's a concept of pseudo 1031 or passive loss harvesting. What does that mean? It actually works for people who are not real estate professionals. What it does is that you don't have to do 1031. You could sell outright, literally sell outright and have capital gains. Capital gain is a form of a passive gain. So take that money in the same tax year, roll it into projects with accelerated depreciation, this bonus depreciation. Get a lot of that depreciation, which is a passive loss. You can actually offset passive gains with passive losses, even if you're not real estate professional. Technique is very powerful. Depreciation can be used by both real estate professionals, which is hugely powerful, and even non-real estate professionals. You can use depreciation, which is known as a form of a passive loss that can offset other passive gains from other real estate, like rental income is a passive gain, or a capital gain on sale of appreciated property is a typically passive gain as well. I know these terms sound a little technical, and you need a competent CPA who does this. But the short version of it, it's really powerful. The depreciation with the right CPA who understands real estate can give you a toolkit that you help you save on taxes.
So what you just described is very similar to what somebody at the Collective Genius Mastermind wanted to do, maybe to sell off some rental properties and then offset that gain by investing in high depreciation funds that have high depreciation. Is that almost what you
Exactly
described
that.
right
That's
now?
exactly that. It's exactly that technique. We literally have. I mean, I'm working on this large deal in Indianapolis, which is closing imminently. We are full on that deal. We oversubscribed to the nose. But we also launched Tempo Grow Fund 2. That essentially has that. It has two classes of units. It has a preferred equity class of units and a common equity. Without a lot of complexity, preferred equity is structured in a manner that it gets no depreciation. So all the depreciation from the fund goes to the common equity, and the common equity gets a lot of it. And people can use that lot of depreciation to offset gains from a sale of another piece of real estate, as long as they both are passive loss versus passive gain. I have another fancy term for this. People love the term, or they hate the term, or they say, "Well, what have you been smoking?" So the passive investment gains, it's when you typically have rental income, or you sell appreciated real estate. They're called pigs.
Something screwy here.
If you can't remember, think about the pigs. Passive investment gains. When you have pigs, You actually don't want to pay taxes. So what do you need? You need what is known as a passive allocation losses, which is depreciation, and they're called PALs, passive allocation losses. So if you got some pigs, you need some PALs. That?
It's
That should,
funny
that should
because
be
most
hilarious.
people
If you don't want to laugh, no problem. I'll take the joke back. But
no,
that's
I'm
the
laughing.
term you used.
It's funny. It's funny because most people think that the only way to sell rental property is to pay the taxes, but if you structure it the right way, there's a way to do it. It's the same thing. Like I understood real estate, Big Mike, i- but I never understood the benefits of depreciation and the benefits of investing in deals with high depreciation as well too. I wanted to ask you, do real estate agents automatically qualify as a real estate professional, meaning that they could automatically take the depreciation that's left over on the rentals to offset their real estate income?
Jose Luis, let me explain this one more time. Most people don't know. So real estate agents or brokers, they're typically real estate professionals because that's their primary trade. You have a few requirements, and these are technical requirements which you can read in the IRS code. As boring as it is, most people know part of the code, not the whole story. So you have to spend at least 750 hours a year, and it has to be a primary trade. You cannot be a practicing doctor doing that full time and also be a real estate professional being broker or agent on a site. It doesn't work like that. But if you practice as a doctor only 100 hours a year, you're retired, but you are now a real estate agent full time, at least spending 750 hours a year and doing the activities of a real estate professional, you will be classified as a real estate professional, right? But that's not enough. Most people think it is, but it's not enough. What you need also a rental property or properties. There's no specific requirements what the property should be or how many doors it needs to be. It could be one door, one property, which is enough. It could be 4 doors, 5 doors, could be 50 doors. There's no right or wrong requirement. But there is a rental property that you basically going to spend rental. You're going to spend hours on that property. It's called 500 hours of passive, of rental activities. So, and you have to materially participate. Materially participate generally means things like this. You go to the property, you pick up the trash. You go to the property, you deal with some repairs. You go to the property, you negotiate leases. You go to the property and collect rent. You can meet with the contractors, with the tenants, we discuss. It simply means material participation. People can confuse. There are other things that you can do that are not material participation, but you have to. That's what IRS code defines. It's material participation and 500 rental hours. If you have those, and you're a real estate professional, your CPA can do a grouping election on your tax return that says, okay, I'm going to group all my gains and losses from everything, and then the losses, which come in the form of a box on your K1. If you're a partner, if you're investing in syndication, you've invested into a couple of deals. So typically, if you're a partner, you get a K1, typically box 2. It says rental income, and it says a loss. Why is it a loss? Well, depreciation is what pushes it to be a loss. So depreciation comes through as a loss on a K1 box 2. Now, if you do grouping election, that can now be grouped against your income as a real estate agent from your commissions. That's how it works on a high level.
So for our viewers, just to understand, like let's say you make 500,000 in real estate profit, but then you have left over 500,000 in bonus depreciation. That means those two just canceled out, and now for federal taxes, you don't pay any federal taxes, right? As long as you qualify as a real estate professional. Now, can someone qualify as a real estate professional without being a real estate agent, just as a real estate
Yes,
investor?
absolutely. Yeah,
Yeah,
absolutely.
they
There's
can.
plenty of trades. You're a developer. You're a redeveloper. You don't have to be an agent. By the way, being a real estate professional does not require licensing. Most people think I have to be a licensed agent or a broker. No, you don't have to. You could do projects. You could do you could do fix and flip projects. You could do um, uh, wholesaling. You could do basically you have to have certain activities which typically involves around real estate. So you don't have to be an agent to be considered a real estate professional. And the power of what you just said, what's really interesting is you could make $500,000 flipping properties, wholesaling, collecting commissions as an agent or a broker, and also own, one rental property and spend 500 rental hours on it and materially participate, and then write a check into a project that have nothing to do with you. Basically, invest in a deal that has massive depreciation. As I mentioned just a few minutes back, we have a project now where investors can write $100,000 check and get in the first year $250,000 depreciation. It's 2.5x. You're gonna ask me how the hell that's possible. Well, I'll explain that in a minute. But imagine you can do that. So you can write $100,000 check and you get $250,000 depreciation, and deduct that against your $500,000 income. So what just happened? You basically saving taxes on $250,000 worth of income. And if you're in a high income state, you're pretty much saving $100,000. So instead of writing a check to the wonderful tax authorities, you are investing in a deal that has potential to double or triple your money or increase your money. So that's the power of the technique. But you have to do it by the book. And I mentioned this multiple times. It's not enough to be a real estate professional. You got to have the rental hours and have that the material to participate. If you do that, then you're pretty much covered. And most people, listen, unless IRS knocks on your door and audits you, you can do whatever you want to do. But to be fully compliant by the book, if they knock on your door and you have that covered, you'll feel pretty well that you actually spend the hours and the time you did by the book, and you can withstand an audit.
Are there any rules of thumb as to how much depreciation you can expect, like percentage wise, like on bonus depreciation? And also, why do some properties have more depreciation than others?
So some properties you can depreciate more, some properties you can depreciate less. It depends on the type of an asset. So, for example, mobile homes are generally pretty well, they're highly depreciatable. You can depreciate a lot of them. Multifamily is pretty well, it's a great asset to depreciate. You have storage, but you have less to depreciate. I mean, it depends on the type of asset class. There are certain projects that you can depreciate more or less in the first year, and there is no right or wrong. It also depends on the type of a building. Some stuff, there's a lot of things to depreciate. Some stuff is fairly new. You could still run a cost seg on a brand new property, just so you know. It's not like illegal. It's perfectly legal. You could build brand new apartment complex, buy it, right? Or somebody build it, you buy it, and you run a cost seg. Perfectly legal. People don't understand. They think, hey, listen, I can only depreciate old stuff. You can depreciate new stuff. The law allows for it. So one of the important points is that it depends on the type of property and the composition of all the. That's why you need an engineer to do a study. But typically, I'm going to use again multifamily, and there's some CPAs a little bit more aggressive, some a little bit more conservative. It's about 30% year one. So if you bought a property for $10 million, it depends on how much allocation to the land, obviously, versus the building and what happens on the property. I've seen it around 30%. So 30% meaning that if you invested $3 million in a property, in the first year, you get 30% of that purchase price. You get literally $3 million worth of depreciation through bonus depreciation in the first year. That's a 1-for-1 ratio. Now, there's a way to magnify that, and that's what we've done. We basically said, listen, in that $3 million investments, if all the investors were equal to each other or pari passu, that everybody would get dollar for dollar invested, right? But what if 60% of our investors, so that preferred equity, they take less risk and they don't need much depreciation, if any. They take very little. And then the remaining 40%, so the 3 million, 1.8 million, just for sake of a discussion, gets nothing, no depreciation, just for sake of this conversation. And then the 1.2 million, which is 40% of the 3 million, they get all of it. When that happens, the 1.2 million collects $3 million in depreciation. That's about 2.5 times the ratio. It's a very powerful concept. It needs to be structured properly with the right CPAs and attorneys to make sure that the people who get that extra depreciation, they take extra risk. And IRS likes to call it, there's a material exchange. So they basically sacrifice something else. They forego something else. They take more risk, but they do get that extra upside and the ability to take extra depreciation.
And just so our viewers know, that's Mike's specialty, structuring deals in a way where investors can receive maximum tax benefits. I did some syndications last year, and just so you guys know, for every dollar that I invested, I probably received like 75 cents on the dollar in terms of depreciation, maybe even 65 cents.
Jose Luis, I can tell you what happened. You got 75 cents because what I've observed is the sponsors, the actual operators who do the deal, people who you invested with, they take chunk of that too. I'm not saying anything wrong with that, but they don't pass everything to investors. In our deals, we generally pass everything to investors. Now I've seen sponsors justifying receiving a little bit of depreciation for nothing other than a sponsor on the project. You could argue with that. It's their decision, and obviously they need to consult with their own CPA. But that's why you got 75 cents on a dollar, not 100. But if a bonus depreciation was 3 million on first year and 3 million investment, it should have been 1-for-1. What I'm using as an example, we run a family of funds. One of them is, as previously mentioned, Tempo Growth Fund 2 has this feature where if you invest in the common equity, you take an extra risk. Eyes wide open. You have to understand you are subordinate to the preferred equity. So they get paid first. You get paid behind them. But if you take that extra risk and you're comfortable with that, you can get extra depreciation. And we estimate it's going to be at least two times what you would get. So you put $1, you get at least $2 of depreciation, possibly more. And I'm going to leave it there because it's really at times it's hard to know exactly what's going to come out until the end of the year, and then all the studies are done and the K1s come out. But it's very possible to get that 2.5 time ratio through the rightly structured syndication or a fund.
So basically, what Big Mike is saying, that if you structure the deal in a way, there's different ways of structuring the deal, and there's some people like Big Mike that will structure it in a way where you get to receive that the people who need the depreciation receive it, and the people who don't need the depreciation don't receive any of it. And by structuring it that way, you can get some tax savings on it. Now, here's one of the things. Last year I was going around our mastermind and I was asking everybody. I was asking, hey, I've heard that you can get 2-for-1 depreciation, or I've heard that you can get 2.5. And most people would say, oh, I don't know of anybody. And then I saw your presentation and then I was like, okay, I found the person. What some of the people were saying is that because it is such a high depreciation relative um, to the amount that you're putting in, that either you're getting involved. They were saying that you were getting involved in a property that either was highly leveraged, meaning that the loan to value ratio was highly leveraged, or that maybe needed too much work. But that's not the case here, because it just has to do with the way that you're structuring between Class A or Class B, right?
So, by the way, great point, great question. The answer to the question is in the question partially. So, to get that large depreciation, you need to have generally substantial amount of debt, and you're going to say highly leveraged. Well, that's part of the structuring is that you got to have what is known as either recourse debt or qualified non-recourse debt. So normally that happens with the traditional structure. You can have primary mortgage, but what we are doing is we're essentially putting the preferred equity ahead of you. So it does increase leverage. So the common equity leverage is effectively could be an example that I gave you could be 88%. So you are in essence highly leveraged through the primary debt, secondary debt, or primary debt and a preferred equity. The answer is yes. That is almost I don't want to call it a requirement, but it's a most likely part of the deal. Without that, the deal you can't get there. Just mathematics don't work. So the high leverage creates extra risk and creates an extra ability to take the depreciation. Say if you're not comfortable with the level of risk, because you basically get enough benefits to write off your entire investment in 1 year. In other words, you put on 100, you get 250 out of it. You save on taxes, so immediately it pays for itself. But you have to be comfortable with a high leverage. So this is not going to be a low risk, super high safety deal. Now, there are other arguments why the deal has safety elements, because of a very experienced operator, because of good value add plan, because of the location, and so on and so forth. So you could build the safety through other methodologies, but in general, that point is accurate that the leverage is high. So I would agree with that.
Okay. Yeah, it's funny because now that you explain it, I'm seeing it. It's still good. You just have to be comfortable, and not only that, but it has to do a lot with the operator and the plan to do with or the value add plan that you're doing basically. So would it be safe to say that in order for this to be a good investment, the syndicator or the operator just has to be getting a great deal on a property where it actually makes sense to have that much leverage on it?
So the answer to the question is it always starts with a deal. You don't financial engineer a crappy deal. If you start with a crappy deal, you're going to put lipstick on a pig. So in our particular case, we are investing with an operator we've known for years. Let's give you an example. This deal that I spoke with at the Collective Genius Mastermind, that we've done multiple deals with him. This property is in Indianapolis. He has, I think, 8 assets in the Indianapolis. He's an incredible operator. He knows how to do renovations. He's got a massive warehouse. I literally just came back from Indianapolis. I was there. I saw the property. I saw all his stuff. I've invested with him for years, and I didn't have a chance to actually go and see. This time I actually came out, and his execution is very sharp. Property management, renovations, materials. He buys in massive volume because he's got so many properties. Everything is standardized, so it's part of the risk mitigation strategy. If you have a great operator, you get to know, like, and trust them. You're very comfortable that they're going to be able to execute the value add strategy, and then you understand that he bought a property at a great price. The price per door is relatively cheaper than you can get something else. So it's a good deal. It's a good value add ability. It's good execution. All those things combined together create safety element. So in this deal, even if things don't go very well, he will create so much forced appreciation that even if the market corrects, and the market can correct, right? The cap rates can expand. You're still likely going to make a decent return on your money, and that's the fundamentals of the deal. So first you start with the fundamentals of the deal, and then you work on, can we financial engineer it to create extra depreciation. You don't want to start with a crappy deal or a crappy operator and say, I'm going to put a Q structure on this to create tax efficiency. I have a good friend. He says, don't let the tax tail whack the wealth dog. That's how he likes to put it. So it starts with a good deal, and then you worry about taxes as a secondary thing.
That's wonderful. I'm going to backtrack a little bit just so our viewers understand this. So regularly in a regular deal, depreciation can be used to offset any rental income that you receive. But by qualifying as a real estate professional, don't have to be a real estate agent, don't have to be a real estate investor. You can actually use any non-used depreciation if you have more depreciation than rental income to offset your regular income at your regular job, basically, to use it to pay less taxes.
Yeah, in general, yes, and I will continue to say the same statement. You have to have the rental property, rental 500 rental hours, and materially participate. If you do that and you're a real estate professional, then yes, you generally can do this. The reason it's important is most people just don't understand it, and I don't want to give inaccurate information. I want to tell them how it is, so that at least they go into this with eyes wide open, and they know real estate professional is not enough. It's the rental activities, material participation, and if you do that, then you take depreciation losses and you invest in a project like this. And by the way, a lot of CG guys are investing with us for that same reason. We have guys who basically make millions of dollars a year doing whatever they're doing, and then they need a tax deduction, and that's what they do.
Yeah, not only that, but when you're getting 2.5 versus 67 cents on the dollar or 75 cents on the dollar, just a much better structure. Big Mike, I think
so
you
rare.
pretty much covered.
Jose Luis, let me just say this. This multiple, two and a half, is very rare. Most people don't understand and think it's about every corner of the street. It's not. This particular deal, the way it worked, is actually a very large deal. It had 60%, very large check, coming from a group that didn't need depreciation because they were foreign investors, and the money was going into another country. Depreciation did very little for them. But the point is, this is not readily available in every deal. Most of the deals, like you said, you'll get 70 cents on a dollar, 80 cents on a dollar. In a good case scenario, you'll get a dollar for a dollar. That's why it's so rare.
Now, here's the last thing for our viewers. I know that Donald Trump in the CARES Act did the bonus depreciation. What is the schedule? When is it scheduled to take a write off the 100%? And what will it look like the next years after that?
Sure. So this year, this is the last year of 100% bonus depreciation. Then we start phasing out. 2023, we go into 80%. 2024, we go into 60%. And then it's scaling down every year after at 20% per year. Now, depending who you ask, I've heard this. There are rich real estate Democrats and there are rich real estate Republicans. So there's a will, generally speaking, in the Congress to renew depreciation bonus at least 50%. So we don't know. It's very possible that this is the last year of 100% bonus depreciation in the foreseeable future. Very possible we'll drop to 80 next year, and then the year after we'll drop to 60, and then the Congress may take action and actually renew it at 50% the following year instead of let it drop down to 40. So we don't know. Maybe they'll renew at 100%, but who knows? So the opportunity is this year. The other really amazing thing that happens is if this depreciation, if you take it this year, carries forward if you didn't use it this year. Most people don't understand. So this is the year to take action because you're still at 100%. Next year you'll be at 80%. It'll probably still be good, just a little bit less good. So the carry forward feature, if you didn't use it, is very, very helpful. So if you're a real estate professional and you did that real rental hours and a materially participate and you did grouping election, let's just say you made $500,000 this year as a real estate agent, but you invested in a bunch of projects that gave you $2 million of depreciation, and you only use $500,000 to offset your current income. What happens with the other $1.5 million? It carries forward. That's the beauty about it. It doesn't go away. So the carry forward is very, very helpful because it'll shield income next year and the year after, depending on how much you get to use it.
Sounds good. And then is there anything else that you like to say about the deal that you're doing right now? Is there still any available positions at all? And how can people reach out to you if they're interested on that?
Unfortunately, no room at all. Too late. I appreciate the interest. People can reach out. They can go on a waiting list until the next deal. So we'll happily share with them upcoming deals when they come up. They don't happen that often, probably 2 or 3 times a year at most, because they take a lot of structuring, a lot of hard work to put it together. So if you go, easiest way to reach, again, remember Big Mike, and I'm a fund manager, so bigmikefund.com. It's easy to remember. It's a website. People can just reach out through the portal, send a message through the bigmikefund.com, and then our head of investor relations will reach out and put you on a list, on a waiting list for these deals. It's how should I put it? Ask around, see how many of them you actually get that look like this, and it's pretty hard. So the other thing, as I said, we have Tempo Growth Fund 2, which is available now, and that fund does have very, very similar feature. It's not for everyone. Some people love it. They love a fund concept. Some people love individual deals. By the way, you asked me before the call one important question, so audience understands the difference. What's the difference between a fund and a one-off deal syndication? And it's a really simple answer, right? So both in a fund or a syndication, you get a bunch of investors who all put their money in the deal. You may have multiple investors, 20, 30, 40, 50, right? A lot. With a fund, you typically have more than one deal. So in a single syndication, you typically have one property. Sometimes you can have 2 properties as a package, but it's a one transaction. With a fund, you have multiple properties, and they are typically acquired over time. So when you invest in a fund, you actually have another great benefit, which is known diversification. You spread your risk among multiple investments. So fund has certain benefits, but the more difficult part with the fund is when you have a single deal, you actually see the deal. You can even go to the property, touch the property. You can understand the property. You can get a pretty good idea what are the target returns. When you invest in a fund, you don't always see everything that's in the fund. You can ask what's in a fund, and typically fund manager can share you the portfolio. So, by the way, it's a great question, but sometimes you don't know what's going to be the next deal that's going to get acquired in the fund. So there are pros and cons, but it works conceptually the same way if the fund is structured similar to this one-off deal where you can get that extra depreciation benefits.
So I want to have Mike on. I don't know if he's willing to do it in the future, but I'm investing more and more in syndications just because California is good to invest in, but some states and some operators come across better deals and also a little bit less management intensive for me that allows me to grow my business. But I want to have Mike back on and I want him to explain like, okay, what do you look for when you're investing in a syndication? What are the different structures that they can do it? I know that there's so many, and also maybe compare it to fund as well too, and maybe go a little bit more details. I know that's a completely different episode, but I saw you talk to Eddie Speed at lunch one time, and I was watching the conversation and how you guys were talking, and I was just like, man, this guy knows the difference, and this guy knows this topic really well. So I'd love to have you back on if you're open to that, and I'd love to have you cover that topic if you are. I think that would be a great topic for our viewers.
Yeah, I appreciate that. I even have a book out on this, but it's another discussion. Certainly happy to talk about. I'll give you a little preview, and we can do another episode. Right? Most people think of a deal. I always think is of a person first. You have to really get to know, like, and trust whoever you're going to invest with. That's a starting point. Doesn't even matter. There are other criteria. Of course, you want to find a good deal, and you want to make sure the structure is good for investors, fair. Because a lot of times you'll have a great operator and a terrible deal. You have a great operator or a great person, good deal but terrible terms, right? There are all kinds of flavors. But if you don't start with a good operator, it's a no go. So that's the first bullet. Know, like, and trust whoever you're going to invest with. That's a step number one always.
Mike, where can they find you? Is it bigmike.com or bigmikefund.com or
bigmikefund.com? And before we go, I got to correct this joke because people have asked me this, and I said bigmikefund.com, and they heard bigmikefund.com. They forgot about the D, right? So the answer to the question is, if you misspell it and you forget the D at the end, I promise it's not a kinky site.
You might end up somewhere else. So he's not responsible.
I
if you
own
end up
both. We own both URLs, bigmikefund.com, bigmikefund.com. You'll get URL forward to the bigmikefund.com. But
that's very smart of you, because otherwise they might have ended up somewhere else.
Yeah, I don't know about that site, but who knows?
All right. Well, for all of our viewers, this was episode number 109. We had Big Mike. He talked to us about depreciation. He talked to us about cost segregation studies and bonus depreciation. If you've enjoyed this episode, make sure to hit that subscribe button. And if you see value in this interview and maybe want to share it with a friend who maybe needs some tax write-offs, make sure to hit that share button. Thank you so much for being generous with your time.
Thank you, Jose Luis, and I'll be happy to come back.